year in which you are liable to pay tax. Very interesting therefore, it's like 45(1) capital A. When there is a natural calamity taking away your capital asset, you don't pay tax in the year in which the asset is destroyed. You pay tax only in the year in which the consideration is received from the insurance company. Similarly, 45(5)(a) tries to tell us, if there is a transfer of a capital asset under a specified agreement, you shall pay tax in the year of completion of the building, in the year when the completion certificate is received from the competent authority. Very interesting therefore, they are only saying that you shall pay tax in the year of completion certificate being received from the competent authority. They don't talk about the year of transfer anywhere whatsoever. So they therefore go back to the year of transfer to our normal understanding of 247(5) and 247(6). If that were to be the understanding, then you will make a statement that, look here, transfer of the property happened the date I entered into the joint development agreement. But I am not going to pay tax then, because the law is now saying it's a reincarnation of 50D in a different form. To say that I am giving you a specified value and also telling you when the specified value shall be considered, now coinciding with the time of arisal of the property, of the income concerned from that property. Now they are coinciding. 50D was looking at an earlier point of time, 45(5) is telling you, no, in the year which the completion certificate is obtained, that is the year that is ripe for the arisal of income to happen or being satisfied there, at that point of time, this income shall be charged to tax. When I make a statement therefore that transfer has already happened, then you're going to ask me, this is a dangerous conclusion you're drawing. If transfer has already happened, that means on the date of the joint development agreement, I am going to find out whether the land was long term or short term, not the subsequent point of time. 1. 2. You will also ask me a question, hey look here, if you were to tell me the transfer happened on that date when the joint development agreement was entered into, what about the time limit for 54, 54EC, 54M and all of the situations concerned? Because law tells us 6 months from the date of transfer you have to invest the amounts concerned, and within a particular point of time, the year of transfer of the land or building, I should invest in a particular house property for me to be entitled to 54 and 54F. So if I were to make a statement that the land was transferred in the year of joint development agreement, logical question would be, what happens to my 54 and 54EC, 54F exemption? The second answer is a little easy to understand because the board itself has come out with a number of circulars on this matter. In the context of 45(2), when I converted the capital asset into stock in trade, the law said, the board circular said, look here, the transfer happened in the year of conversion, but I will give you time for investing in capital gains from the date of actual receipt of consideration by you. Board gave circular. We have 54H into the statute which says, although we have had a transfer of an acquisition, transfer by compulsory acquisition of property concerned under 45(5), when you get the enhanced compensation, there will not be a separate transfer, only your taxability is deferred. But for you to get the benefit of 54, I will reckon the period from the date of receipt of consideration being the enhanced compensation. You are also getting the consideration much later, and therefore I could make a statement, the consideration having been delayed, the philosophy of the board circular, the philosophy of 54H should help me to say that the time for the investment should run not from the date of transfer being the date of joint development agreement, but should run from the point of time when the actual consideration is received by the person concerned. Therefore, the question arises that in situations where there is a transfer of this nature, the transfer has already happened, and it's in relation to that transfer that the capital gain should have arisen, but the law says no, wait for the completion certificate and the fair market value of that property when received by you shall be the taxable quantum, or shall be the basis for determining the quantum of income on which you are liable to pay tax. The precondition for all of this is that you should have a specified agreement. Specified agreement is what? It's a registered agreement entered into by a person concerned. Registered agreement entered into by a person concerned. This gives rise to a very interesting proposition. Now, I have the law available with me. The law available with me is enter into a JDA, assume it's a transfer, don't register the agreement concerned, don't make it a specified agreement, go to 50D of the Income Tax Act and say what shall be the quantum on which I am liable to pay tax in the year of joint development agreement. So in the year when I am transferring it, I take the fair market value of what is happening going out to be the starting point for the purpose of capital gains computation. If you think that's fine, go ahead with that. If you think no, Something else is fine, that it's better for me to get the registered agreement done, making it a specified agreement. Then I'll wait for the year when I receive the completion certificate. Only at that point of time I'll pay the tax concern. Now this is very interesting. To again go back to what is the specified consideration for 45(5)(a). We are looking at an example where 60% of the land is given up in exchange for 40% of the superstructure, such that at the end of this job concern or end of the exercise concern, the developer is the owner technically for 60% of land and 60% of superstructure. The landowner is the owner of 40% of land and 40% of superstructure. So 60% of land is gone. What am I getting in return? I am getting 40% of superstructure in return. This is a very important point for us to understand. So what am I getting is only a superstructure concern. So what should I value when the completion certificate is received for the project concern? I should value only the superstructure, that is the amount that is coming to me. That's the value of an asset coming into me. I don't have to take into account the underlying land, because underlying land through and through belongs to me. There's no question of transfer of this underlying land. The land is already mine, it always was mine. What I now get is 40% of the superstructure. Now believe me, the value of land are appreciating, guidance value of land are appreciating, the value of building are not appreciating that much. Therefore you have to make an evaluation that whether the time value of money for 2 or 3 or 4 years of going beyond the joint development agreement till the time you get the property back from the developer concerned, and I only have the valuation of the fair market value of the superstructure being taken into account, would that be beneficial to me? Or I go back to 50D to say, hey, look here, 50D is very easy for me, that's a very low valuation, I'll therefore go by that valuation concern. And today therefore, persons have options now to go by 45 red with 50D or 45(5)(a), deferring the capital gains to any year of your choice. That will be a very interesting proposition for us to work out to say as to which are the options you will go by. There were two other questions being asked as to what happens to existing projects. Question therefore was, is this section 45(5)(a) retrospective in operation? Is it retrospective because they say for the clarification of doubts? Therefore, is this clarification of doubt being in retrospective? Number of other issues also you will find under statute for the purpose of removal of doubts, for the purpose of clarification. This is under the rationalization and simplification measure, not under retrospective measure. If you go into the memorandum, it talks about the rationalization and simplification measures. Therefore, this is, although they may say for the purpose of doubts, clarity, they are not laying down in retrospective application. Therefore, what has been done should remain in relation to the law governing the transaction at that point of time. I am making this statement very particularly because there is also a question asked about Atwal's case. What happened to Atwal's case? Atwal's case, Punjab and Haryana High Court had made a particular statement. That not happening or gelling well with what the Karnataka High Court has held in Jaira's case or Dayalu's case. Not gelling well with what the Bombay High Court held in Chaturvedi Dwarkada's case. Not gelling well with what the AR held in that Surjit Singh's case. Therefore, depending on what is the area by which you are governed, the High Court jurisdiction, some transactions or some jurisdictions have said that the transaction happens in the year of joint development, will have to be governed by those laws concerned. If Atwals were to come to your rescue, then you will say, I will not pay tax based on Atwals decision. I now go by the new law concerned to say, I am going to be taxed by the new law and I am going to therefore pay tax only in the year in which the completion certificate is received. So existing provisions will go by the respective law. There could be some element of dichotomy there, some element of inconsistency there. It's precisely to get over this inconsistency that the law is now sought to be settled. Prior to this, we will therefore go and live by this inconsistency. If we are able to fight the battle to say that there is no transfer on the date the joint development was entered into, then you can defer the taxation to the year of completion of the certificate, the completion certificate being received. Now, law talks about a completion certificate. Inquiries in Maharashtra tell me that there is no completion certificate being issued. Karnataka inquiry tells us that no completion certificate is issued, only an occupancy certificate is issued. Therefore, there could be trouble in relation to what happens to a situation where completion certificate is not available. This is one part of the story. Second part of the story is a completion certificate of a person who is authorized to sanction the building plans. Does it presuppose therefore that land development is not covered with 45(5)(a)? I am only developing lands. I don't therefore develop lands. I have sites being built out and served. Land development happens. Interesting, the law says completion certificate, whatever be the completion certificate, should be given by a person who is empowered to give building certificate. They don't make a statement that the completion certificate shall be only pertaining to building. They don't say that. They are only saying who is the competent authority to give a completion certificate. The competent authority to give a completion certificate is that person who is authorized to sanction building plans. If that whoever to give you a land certificate, completion certificate also, I don't think there will be issue. They're only designating the authority concerned. They're not necessarily saying that the completion certificate shall be issued only in relation to buildings. If you're able to get therefore a land development certificate also from the person who is competent to sanction building plan, you should be able to satisfy the section. Question was asked therefore, what happens if I get a part completion certificate, and therefore there is a context in 247(5). Could there be a part transfer when, let us say, I have 10 acres of land, I have entered into an agreement to sell, I have only given 2 acres of the land to the developer concerned. So what should be the taxable quantum? Can I say now that the whole 10 acres have been transferred, or should I say only 2 acres have been transferred? That possibly is addressed now indirectly if you want to go into 45(5)(a). You can get the answer there if you were to analyze 45(5)(a). Possibly therefore apply the logic of 45(5)(a) to what's happening in 247 clause 5. What does 45(5)(a) tell us? You can get a completion certificate for what? For the whole of the project or a part of the building also. Obviously therefore law is contemplating part of the building being envisaged. They're saying you can get a completion certificate for the part of the building. That portion is okay. Now when I get a completion certificate for a part of the building, the logical question is, what should happen whether it is a transfer of the whole of the building or transfer of only a part of the building? We are tuned to believing that it is a whole transfer, not a part transfer. But I said that the answer is available to us in the 45(5)(a) because Law 45(5)(a) tells you the quantification of this also. It says the fair market value of the building you are getting shall be the full value of consideration. So let us say therefore 10 million square feet of building had to be constructed in 4 different towers. One tower is complete, 2.5 lakh square feet is complete. I am getting a completion certificate for a part of the building itself. Now should I pay tax in relation to the entire 10 lakh square feet? No. Law tells you the fair market value of the building that comes in. When the building comes in, I will pay tax. The building will come in 2, 3, 4, 5 years later. I have only taken a completion certificate for a part of the building. It is only in relation to this part of the building I am able to quantify the fair market value. The balance will come 2 years, 3 years down the line. I can't speculate about what shall be hypothetically the value of those buildings whenever it is going to emerge in future. That concept is not there. Therefore, 45(5)(a) also will give us an answer as to what will happen when a part of the building is complete and you are able to get a completion certificate for a part of the building. An analysis of that section concerned to tell us that it should only be the consideration based upon the completion certificate. That means the fair market value of this building only shall form or constitute the consideration in relation to the capital gains computation, thereby indicating that part completion, part capital gains, extent of completion will determine the extent of capital gains. This logic should also be, or can also be applied to 247 clause 5. And I am also aware of a number of tribunal decisions saying part of the property being transferred, not the whole of the property being transferred. Even therefore for 247(5), a proportionate consideration has to be taken into account. The problem for us also would be, the law talking about what? The fair market value of the consideration to be increased by the cash component of consideration. 45 has very interesting words. Therefore, question is, I have hypothetically a very small portion of the building and I have a huge component of check. Therefore, the question the answer is, if I were to have this combination, law tells me fair market value of the building along with cash component or cash consideration should be cumulative to tell me what is the value, full value of consideration. If I were to read the law very literally, therefore, it says cash. Have I received cash? No, I have not received cash. What have I received? I have received shares, I have received check, I have received bank draft, I have not received cash. So can I therefore beat the law by saying 45(5)(a) very literally read talks about only cash consideration, nothing else? To me, that's not the correct way of understanding the law. You can get some sort of an indication when you go into 94 capital B that is introduced in relation to thin capitalization rules, and 92 CE deals with the transfer price is secondary adjustment. In relation to secondary adjustment, they are saying the purpose of secondary adjustment is to equalize the cash account with what is to be received from the person concerned. The word used in 92 CER to equalize, to remove the differentiation or distinction between the cash account and the amount due recorded by the foreign companies also. So the word cash account is used in 92 CE also. The indication is not necessarily to have cash component, to look into an equivalent sum that is paid otherwise than by a kind, could be by check, could be by bank draft, could be any other mode. The combination of, therefore, the building and the cash component together shall be the value of the liability to pay tax. Now, rightly or wrongly, they have not thought about this process very completely when going to 49 subsection 7. Very interesting proposition comes about on a reading of 49 subsection 7, because the law tells us, if this property in relation to which I have paid tax under 45(5)(a), if I were to sell this property tomorrow, what should be the cost of acquisition of the property when I were to sell this property tomorrow? That should be the logical way in which you go about 45(5)(a), move to 49 subsection 7, determining actual cost in particular circumstances. I'll give the example of a logical example of, let us say, a case where I have received 40% of the superstructure and I have received a good amount of check compensation. I'm adding these two. Let us say that the value of the building is, let us say, 20 crores and the value of cash and check compensation is 5 crores. So total amount is 25 crores. The law tells us, 45(5)(a) tells me 25 crores should be the value on which I am liable to pay capital gains tax, reduce the cost of acquisition of the building concerned, accordingly I pay capital gains tax. Now I have two components, the building component of 20 lakhs and a check component of 5 lakhs. Together will give me the capital gains consideration. When I were to sell this building, logically it should have been only 20 crores that should have been the cost of acquisition of the building when I am selling this building all over again tomorrow. But then 49 subsection 7 says that amount that had entered into the fair market value computation under 45(5)(a) shall be the cost of acquisition of the building when it is sold tomorrow. So what is the value, what is the amount on which you are paying tax under 45(5)(a)? It's the value of 20 crores plus 5 crores. 25 crores is the value on which you are paying tax. I'll repeat again, building is only 20 crores, check is 5 crores. 49 subsection 7 says, when you sell this building, you can take 25 crores all over again as the cost of acquisition. In my opinion, may not have been the correct way of drafting the law. There is some sort of a slip available and visible for us. As long as the law does not rectify that, we should be able to take 49(7) advantage to say that when I am able to sell the building tomorrow, the amount of check component also shall enhance the value of the building when I determine the compensation receivable by me, when I determine the cost of acquisition in relation to this property that is transferred by me tomorrow. If I were to, before the receipt of the completion certificate, transfer my share in the property concerned, the law tells you, will not help you in this manner. You'll have to go back to the erstwhile law. Forget this section 45(5)(a), forget this section itself. And therefore, what will be the law otherwise applicable to you shall govern the transaction if you were to transfer your share in the property before the receipt of the completion certificate. But what's important, therefore, are two things. One is the completion certificate being received by you, any act done, the whole law will not be applied. The second important point would be the registration of the specified agreement, extremely important. Law does not specify as to what shall be the time by which you shall get the agreement registered. Logical way would be, you should have the agreement registered prior to the receipt of the superstructure by the landowner. That would be a better way of doing things. To say that I have received the superstructure prior to the completion of the building, I have received the superstructure, and prior to the receipt of the superstructure, the agreement has been registered by me. Therefore, the precondition of 45(5)(a) has been satisfied. There has been a case where I was asked as to what will happen when I am entering into an agreement with the developer for developing this property. Should it necessarily mean, should it mandatorily mean that I have converted this land into a stock in trade? Is that a mandate under the law to say that I have converted this into stock in trade? There are two ways of addressing this issue. To me, if I am the owner of a land for a long period of time, land is reasonably large in size, I don't have the time, nor the finance, nor the expertise, nor the wherewithal, and therefore, for having the best benefit derived by me from out of land, I am therefore getting into a builder concern. This act of mine does not therefore mean that I have converted this into a stock in trade. One. Two, stock in trade presupposes that you're going to offer this income as business income. Business presupposes that there is a continuing, systematic, organized activity by you. No, when the land is given to me, I'm a passive participant in the transaction. I don't have any continuous activity. I don't have any organized activity. I don't have any systematic activity. Except that entering into an agreement for the purpose of protecting myself and getting the best value out of land, I don't do anything further with the land concern. And therefore, for this reason also, to say that I am not involved in any continuous, systematic, organized activity, there's no question of me regarding this land as having been converted into stock in trade. If I were to say that land has been converted into stock in trade, assuming for a moment land has been converted into stock in trade, the question is, fine, there's a transaction of transfer, I am computing the capital gains, but I am freezing the capital gains today to be taxed when? When I sell the stock in trade ultimately. When I sell or otherwise transfer the stock in trade. Now, when I enter into a joint development agreement in relation to or with the vis-a-vis the stock in trade, have I transferred by entering into a joint development agreement? That's the second question. Now, joint development agreement constitutes a transfer in relation to an asset, which is a capital asset. Capital asset excludes stock in trade by definition of 214. So 214, stock in trade is not a capital asset. So by entering into 53A of the Transfer of Property Act does not constitute a transaction of transfer. I have to go back by the normal understanding of transfer in relation to a stock in trade, which by Supreme Court decision, Alapati Venkataraman, a number of cases would say transfer happens when the sale happens, when the sale is registered, or when significant risks and rewards in that property are transferred to the person concerned. Therefore, mere entering into a joint development agreement as or with a stock in trade will not eventually mean that there is a transfer for me to be liable to pay tax right upfront today. And therefore, either grounds, whether you call it as a stock in trade immediately, which is going to be a difficult proposition, you're not going to pay tax right now. And to me, fundamentally itself, we could eminently argue that merely granting of land to a joint developer for the purpose of constructing or doing a project concern should not tantamount to a transfer as understood. It should not be amounting to a conversion of this stock in capital asset into stock in trade. People are asking questions on one structuring I have given in the paper concerned, where a partnership firm is converted into an LLP. Two brothers are there in a family, developing a number of properties, having a number of assets in a partnership firm. Now, they want to ultimately divide the assets concerned. So with that background in mind, we had to look at certain structures as to how do you divide those lands concerned, making it a very tax efficient structure. So we normally talk about having two firms bifurcated. One partner remains with, let us say, 8 assets are there, 4 assets have to go to one brother, 4 assets have to go to another brother. One way of looking at things would be, I make 2 different firms and transfer the assets concerned. Then the original firm will have to pay tax and stamp duty in relation to all the 8 assets. It's going to be a difficult proposition. So one way of mitigating the things would be, look here, I transfer only 4 assets to a new firm. That means therefore, one of the brothers concerned will have the old firm with him. Only in relation to 4 properties going to the new firm, I'll have stamp duty and capital gains implications. Therefore, I'm mitigating capital implications to some extent at least. I'm also mitigating stamp duty implications to some extent concerned. Next is, we are having the Bombay High Court decision, Express case, Karnataka High Court decision, Unity Health case. Therefore, convert the firm into a company by taking advantage of the erstwhile Part 9 and make a statement of here. There is no transfer at all, and therefore the property can move into the company without any tax incident. It may not also have stamp duty implications. But what we're doing now is converting this into a company-owned assets. How do you again bifurcate into 2? Possible to go back to a demerger concern to say 4 assets go to this company, another company, then you have a demerger process. Therefore, you'll have a court proceeding concern. 1. 2. The resulting company has to give shares to the first owner, company's owners. Therefore, both the companies will have both the shareholders concerned. Unless you have cross-holding gifts being given, you'll not be able to achieve your rights. Therefore, going through a Part 9 company and therefore having demergers concerned and having a realignment of the shares concerned may also be not a very efficient solution, may also involve time, may not therefore satisfy. Therefore, we are looking at some propositions as to how we could go about. And one idea we thought about therefore was, can I convert this firm into an LLP? LLP Act today provides for converting of the firm into an LLP. Question therefore is, conversion of a firm to an LLP, whether it is a transfer at all. Group raised the issue to say, may not be a transfer because the department is not giving a new PAN number. The department is saying, under 223, a firm is a firm, even an LLP is to be regarded and assessed as a firm only. So as far as the entity characterization is concerned, a firm is a firm, even an LLP is a firm, it doesn't undergo any change. Therefore, for all practical purposes, this LLP is also to be regarded as a firm. If it is regarded as a firm, there is no question of obtaining a new PAN number. We will not give a new PAN number. Therefore, the argument was that this itself presupposes that the department is considering these two entities as one and the same, and therefore there is no question of any transfer. This is one part of the story I thought possibly a practical way of looking at things. But the legal way of looking at things would be that a LLP is a distinct legal entity, distinct from the partners comprising it. Therefore, the inherent characterization attaching to a firm will not attach to an LLP. It's only for the purpose of taxable entity or tax purposes that LLP is assessed as a firm. There's therefore a difference between whether an LLP is a distinct person by itself. LLP is definitely a distinct person by itself. It's not just a separate taxable entity, it's a distinct person by itself. That's the common law understanding, and we need to therefore appreciate and respect the common law understanding and make a statement that when a firm were to convert itself into an LLP, there is a transition from one form of ownership to another form of ownership, that we are now getting into a body corporate type situation concerned. Therefore, there is some sort of a movement from a firm to an LLP. There is a transfer, there is a change from characterization of a firm to LLP. Therefore, the proposition that the department is using the same PAN number may not necessarily help us to bail out from this proposition to say that there is a transition from one entity to another entity. But the more important issue is the philosophy of the rationale of the text-in case should survive to benefit us. What does text-in case say? That there has to be a transferor as well as a transferee for you to be satisfying the definition of transfer. Somebody has to be a giver, somebody has to be a taker. Only one entity is existing, one kills, another emerges as a result of killing this. Then there is no question of the transferor as well as the transferee existing simultaneously at that point of time. As a result of it, therefore, the fundamental condition or the prerequisite for a transfer is not satisfied when a firm converts itself to an LLP. If that were to happen, then we are able to say, applying the logic of text-in case, there is no transfer, the automatic vesting, no further act or deed is required to be done. What are the firm's property becomes the property of an LLP, another cloak is worn, another dress is worn, there is no transferor, no transferee, there is no transfer but a transformation. There is a difference between a transfer and a transformation. There is no transfer. The firm itself is transforming into an LLP, therefore transfer is different, transformation is different. What's happening now is a transformation that does not satisfy the definition of transfer, and text-in case and number of other cases should help us to say that there is no transfer when a firm is converting into an LLP. If that were the situation, the transfer should happen to the LLP all property is concerned, and thereafter use the mechanism of 45(3) to say that these properties are contributed to one firm, another firm, two firms. The LLP is becoming a partner in these two firms concerned. Therefore, the brothers will decide 4 properties go here, 4 properties go there. And we are able to plan out stamp the implication in respective firms using the logic of section 14 of the Partnership Act, which says the mere intention of the partners concerned to convert their property into a firm's property is sufficient. There is no need of a documentation required for that intention to be given effect to. You may, for the purpose of record keeping, have a document executed, but then the mere intention is sufficient to convert an individual property into a firm's property. So many states do have a regulation concern. You have to go back to your respective states and find out what's happening there. Many states do have a regulation saying what? Stamp duty is associated with a document, not with a transaction. It's associated with a document, not with a transaction. Therefore, if I have a transaction of contributing an asset into a firm, That's the transaction. If the transaction happens to a document, I am liable to pay stamp duty. If the transaction were to be accomplished without a document, I don't have to pay stamp duty.